All right. What is up? And welcome back to How to Invest in Commercial Real Estate.
What is up?
The rent.
Yeah, buddy.
On all of our tenants?
Yeah, for real. Yeah, that's life. That if you're a tenant, your rent's getting more expensive. It's not us, it's the world.
Yeah.
Unfortunately. Anyway, we are back here filming another episode. Best podcast in Jinx, Oklahoma. Still undisputed, I think. We're the challengers.
And 91,000th in the world.
Yeah.
We looked that up today.
Yeah.
And gaining.
Yeah, we have a lot of work to do. A couple of updates.
Yes. Monday, today, actually, the day this podcast drops, we bought 3 deals in Texas, 2 in Amarillo, 1 in Victoria. Nice. Super excited about that. That means we bought just under $20 million worth of deals this month, over 4 assets.
Yeah, and Precision has got an apartment deal closing in a couple weeks. Yep. So
nice.
Yeah. And for those of you that live in the area, go check out Iconic. It's finally about done. We're moving in our first residence this weekend. So
that's nice.
Super excited to get that thing filled up and see how it does down there in downtown Bigsby.
Yeah, it's exciting. You know, you guys did the plans for that one apartment complex in BA and sold that. So it was exciting to see you guys, you know, develop this one. It's a gorgeous building, and it's hard. It's hard to build gorgeous buildings.
I mean, development isn't easy. It's been a big learning curve for us, and the project's been delayed quite a bit. So ask me in like 9 months how I feel about developing apartment complexes, and I'll tell you.
You should know more now.
Soon. What else? Any other updates before we get going into the topic?
Second quarter distributions and updates are going out. They should have gone out last week. So you should be getting your money here in a couple days. Super exciting. ACH to your account.
Nice. Saw that. Mine came through. The money didn't come through.
Email. Yeah. Some of those are getting up there. Like the ones we bought 5-6 years ago that are really tenured in. Rent growth is really grabbed hold. It's good to see properties exceed your expectations. That's my first thing that I do is go back and look at the original model and just think, what did I think it was going to be paying out? What are we actually paying out? Obviously, you're not beating it on every single deal, but a lot of them consistently outperform what we underwrote, which is exciting to see.
Yeah, and I always say, guys, my advice when buying these deals, when I first started buying them, I was so worried that all the tenants were going to move out or something was going to go wrong. But most of the deals do about what we think they're going to do most of the time. Mm-hmm. We have some that do better, and we have some that don't do as well, but most of the deals do about like we think they're going to do. So that's why we tell you to diversify. If you try to hit one, you may or may not get it. But if you're invested in 5 or 10 deals, you're going to be getting the returns that you think you're going to get on average.
Yeah, definitely.
Yeah, it's funny because we see it, but we see the investors that just try to dabble on 1 or 2, and if even one of those doesn't quite do what we'd hoped it does, then
they lose faith.
They lose faith.
Yeah.
Or it's just it doesn't actually build up the trust and confidence they need because it's still 1 versus 4 potentially. Yeah. Right? If you're getting 5, 6, 7, 8 different update emails, you're going to get the feeling, oh, these all kind of do about what they think they're going to do versus 1 or 2. You're like, it's just 1 or 2. So still, just so you hear it from me, you know, I would rather have 4 smaller checks than just 1 large one. Mm-hmm. And we're doing, like this month we did 4 deals. There were 2 different investment offerings. Just this month alone, you had 2 different opportunities to get invested, both in Texas, but completely different markets in Texas. Tons of different tenants you're diversifying into, the time you're diversifying into. So lots of advantages in getting involved in several deals.
It's setting a record, $20 million this month. And closed acquisitions.
I'm not sure it was quite. It was like 16 and 3. It's not quite 20, but 19 and change.
19, almost 20, man. That's still pretty awesome.
Yeah, and 4 deals is definitely a record. Even when we were doing the Petromax stuff, we ended up in close to 4, but they were 2 different months. So it was 3 and 1. I think 4 is the standing record for number of deals closed in a month. It'll be hard to beat.
Yeah, and we want you guys to join this effort, man. We're doing on average maybe a deal a month, but I have a vision to what if we do a deal a week? Yeah. You know, how many investors do we need? How much money are we going to be making the investors so we can pull that off? So
that'd be nice.
All right, Brian, tell us about the show today.
Okay, we're going to repurpose a show that we did way back when we started.
Back in NAM.
Yep. Somewhere within the first 30 episodes, but it's how to spot a deal or how to evaluate a deal in 15 minutes or less. So we came up with some topics, and the first one that we thought about was to know your strike zone. So when you look at a deal, you know quickly what's your strike zone and whether it meets that, right?
Yeah, for me, I wouldn't have been able to do this show, several years ago because we hadn't really zoned in on what we feel like is a repeatable sweet spot for us at Criterion. Precision, we still do a little bit of multifamily, a little retail, a little development, but Criterion, we're getting in a groove of knowing what we like, and so that's why this show is going to be really relevant. Because we really have honed in on something that we feel like works. So
this isn't just shit. This is what we actually do.
This is literally what we actually do.
We did it this morning.
Yeah. We literally do it every Thursday morning at 10. Yeah. It's so true. Yeah. I forgot about that. I slept since then. Yeah.
So know your strike zone is right now, given where debt is, we know that, barring any, weirdness about the property, we're looking for an 8.75-9 cap deal. That's what we're looking for. We're the size, right? We're not looking for 20 million, and we're not looking for 2 million. It's really $4 to $12 million is our strike zone.
And it's just to repeat. This morning we literally found a great looking deal, but we were, Joel was like, "It's 20 million, guys. Yeah. Are we really going to do that?" And everyone was like, It's just easier for us to go do what we're good at, which is $5 to $12 million deals. I would rather do three of those than a one big $20 million deal. It's a completely different lift. It's a completely different strategy. It's a completely different, a lot of things, different lenders, different risks, equity partners. Yep. Anyway.
And we're going to get into some of the other points later, but another one that we looked at this morning, and it was just in a small market.
Yeah.
That was not near a big market. Yeah. It's one thing if it's a small market 30 minutes outside of Dallas or something. Okay. But this was Nowhereville in the middle of nowhere. So nice looking deal. Probably can get it at a 9 cap, but we had to pass because it's got 15,000 people in the town. So, All right, next.
All right, the next one we said was the power of a one-page snapshot. So it's like what? Rent roll. Look at that real quick.
Rent roll and some pictures, and we can figure out the rest.
Yeah.
Yep. A good OM, though, will typically have, some demos that I like to see. Demos is probably the next thing on that list. Rent roll, pictures, demos.
Traffic counts.
Traffic counts. I'm dangerous with that information. Yeah. Super dangerous.
Yeah, those are some of the first things we look at, right?
Yes. When you hone in on the power of a one-page snapshot, you can get a lot of off-market deals. And what I mean by this is to buy off-market deals, you have to be willing to kind of scrape up a lot of data with the little bit you're provided, because it doesn't have this big, beautiful offering memorandum that a broker spent 100 hours on putting together and collecting all of this data. There's value to that, and that's why you can sometimes get a deal off-market, is because you know that's your strike zone. It fits all of those initial parameters, and then you've got this limited information on one page. Rent roll is typically a page, and then a picture of it.
Yeah, I mean, I could probably list the 10 things that we need to know to make this decision, and we talked about a couple of them already. Deal size is one, market size. Demographics, we probably want higher than 65,000 in average household income. That's a floor. Traffic counts, we want no less than 12,000 vehicles a day. Things like that. All right, next one.
Well, we covered some of these in the first talk, but these are red flags that kills a deal instantly. Like, I think one thing we've learned is visibility. Right? We bought a property that didn't have good visibility, and we're having a little trouble renting it up. But so now that's one of the things that is a red flag. If it's too far off the main highway or a main road, then
or doesn't face. Sometimes they build these that are facing sideways, and so you have a couple tenants that are close to the road, but the other tenants are so far back. Driving by, you're not going to see them, and so that's a big red flag for me. Too much big box space. You might have one that's a little bigger, but if you've got 2 or 3 massive big box spaces, we're going to have to give it a pretty hard look. Yeah.
And again, this for us, right? This is what we know we're good at. We know the strike zone of what we're buying. So it's not like big box is bad. A lot of people only buy big box stuff. From their perspective, if it's got too much shop space, they may pass on it.
Now, so we do have some big box space. But I wouldn't go in and purchase a big box space today if it didn't have something like really, really low rent or a really, really strong retailer on a longer lease, things like that. Because I have 50,000 square feet that's vacant in our deal in Florence. Now I've got a really strong offer from a great retailer that I think I can make work. But
you were kind of saying that same thing a couple months ago.
I know. Well, I actually have an LOI now.
Okay.
So now we're just negotiating.
I'd say another red flag for me is like $700 a square foot. Or just something ridiculous. You know that rents are kind of artificially inflated. There's probably a massive tenant improvement package. It was very expensive to get that tenant in. I don't like having to replace an above market rent. I like to be able to replace it with somebody paying more rent because you're so low. So I know that's initially just not going to work with my rent growth projections when it's that expensive per foot.
Yeah. And if the rent is too high, we're going to be out.
That kind of, I didn't mean to interrupt, but that kind of takes us to our next topic, which is show me the spread. We had a few topics there, and one of them was the spread between the in-place rents and market rents, right? We want to know that. We want
the
be
fancy
able to,
people say mark to market.
Yeah.
You just hit them. Just hit them in the face. Shut your mouth.
Yeah, I mean, this is a good one. I mean, the whole goal is to increase the value. And not just maintain the value.
There's the number one secret right there in how to invest in commercial real estate.
Yeah.
The goal is to increase that.
Find a way to increase the value. And so, we need something. We need something to increase that spread. And so if the rents are below market, great. That's a starting point. If the rents are at market, what else can we do? Are there chances to get huge increases in the future? Are the leases about to go into a renewal where we can negotiate a higher rent? Are they all on gross leases and we can take them to triple net leases and build the NOI that way? So we just need to have some way to increase the spread or increase the value.
Yeah, and a note on here, can I beat the cost of capital? You definitely should be beating it, but you should know what your cost of capital looks like. And for me, what that means is what are my investors' minimum returns that they would take? Not how much can I get away with as little paying them as possible, but just what is a market return for somebody wanting to invest in this? What do I think would sell? What do I think they would buy? And then, what is the cost of debt? Obviously, that's the biggest chunk of capital in the capital stack. You should be talking to lenders all the time. You should know within half a point what the cost of debt is just nationally on the stuff you're buying. You should know that.
Yeah, and if your cost of capital or debt, let's say they start with debt, your cost of debt is at 7%, like today it might be for a retail deal that's a recourse lender. Okay, you're not going to go buy 6-cap deals, right? You can't because you're getting 6%, but you're paying 7%.
Yeah.
And then on the investor front, we're pretty generous to our investors. If you're an investor of ours, I get these Facebook ads all the time. And they're guys like, hey, we have a cash flow retail asset and we're going to, pay you 6%, cash on cash. And we're going to pay you a 12.5% IRR. And they act like it's some awesome thing. And I know they're raising money. Yeah.
We'll take your money.
Yeah.
We have better deals than that, guys.
We're not quite doubling that, but we're doing way better on almost all of our deals. We are an 8-pref type of capital raiser, and we're shooting for double-digit cash on cash and 20% IRR across the portfolio. So they don't all hit 20. Some are 18, 19, some are 20, 22, but we definitely do beat the cost of capital. So
yeah, more importantly is the last deal we did was an 8-pref 70-30 split. So we're structuring it in a way to where if we do hit it out of the park, the investors are winning big, right? We're not taking half of the back end profit. We've seen these deals out there. That's probably what that deal is, right? It's an 8-pref and a 50-50
and not
split.
say we won't ever do it, but
sure.
if we're taking, if we're giving, normally we're giving the investor 70, but if we're some deals, let's say we give the investor 60, it's only because we believe the deal is going to return them better numbers than normal. So,
yep. Sure.
Okay. The next thing we said on spotting a deal in 15 minutes or less is instinct is earned through repetition, right? Criterion's getting to the point now where we've looked at so many deals. I know Joel has for a long time, but
Joel doesn't look at deals.
He's no different. But the intuition now kind of kicks in when we're looking at deals, right? And it's kind of all these things we've said previously.
You can almost elevator pitch it. You can almost get on the phone with one of us. It happens several times a week. I'm on the phone with Jackson, Joel, Aaron, Andy, Brian, and just going through, hey, here's this deal. Yeah, here's the market. Here's the cap rate. Generally, rents are stupid cheap. We're going to raise them here. Rollover is low. I've got a lender that's interested. You can pretty much spitball some points in a deal, and I'm like, yeah, I don't hate it.
And some of the negative deals, like, oh, we've got a problem with visibility or something. I mean, yeah, we can do a 1-minute elevator pitch.
Yeah, and then it helps you not get emotionally attached to the deal. I think this is a big rookie mistake, and just kind of anything, people get emotionally attached to stuff. People get FOMO. People obviously have, buying problems just with stuff in general. And I think people have this emotional attachment to real estate in the beginning where they only want to buy the cool local thing, the gorgeous building. Like we're buying stuff that kind of looks like crap in Amarillo, and that's selling way more, than the okay looking stuff in St. Louis or Atlanta or something like that. It just, you can't get emotionally attached to these things. You have to know, like we said, know the strike zone, know what you're buying, know what you're looking for. A lot of the stuff now we're finding is even off market. Brokers are going to our website and saying, hey, this looks like everything else you're buying. It's off market. I know the seller. I've been trying to get this to move. If you guys can write this offer, I bet we can get it done. I mean, it's just, it looks the same. You're looking at so many deals a week. We're closing so many deals. We're talking to lenders on these deals. We're talking to investors on these deals. Everyone is sending us deals.
It's funny. We could have looked at hundreds of deals, 5 years ago, and we still would be second guessing ourselves. But now that we've purchased so many, it's once you start to buy and you start to experience the problems, but also experience the upsides and learn. And now we've had the conversations with this tenant, and we've kicked that tenant out, and we've negotiated a higher rent on this tenant, and dealt with these water problems over here. All of that just continually feeds into your experience. And that's why we say that the reps build the intuition on what deals are going to work and what deals aren't. And so now we can look at 100 deals and feel good that we're evaluating correctly. Before I would have been looking at them, but I would have been, is that one going to work? Is that one going to work? I'm looking at them, but I don't know exactly how it was going to go. And so with all the experience that we're getting now, it's really starting to feed the engine. And I love it.
One of my favorite things is, how do you guys do a renovation in Amarillo? How do you do that? What do you mean? Like, you call 3 roofers. You literally go to Google, roofing company Amarillo, and then there's like 500. You know what I mean? Yeah. You call a few, you get some bids. You've obviously got a local property manager in Amarillo. Obviously, we're in Tulsa. You obviously have a property manager in Amarillo. They're probably willing to meet the roofer on site. Probably. Most roofers won't even go to the site these days. They measure on Google Earth. So that's eliminated. So like painting, asphalt, all of these things, you call them and say, hey, I own this deal in Amarillo. I'm looking to get it painted. Could you drive by there and give me a quote? And they say yes. And then they email you a quote. And then after the work is done, before you pay them, you have that local property manager go out there and say, hey, is my building repainted? Does it look good? And they're going to say, yeah, it looks great. Sweet.
Here's some pictures, yeah.
It's easy.
So, and depending on how you structure your leases, a lot of the renovations can be passed on to the tenants. Not always, and the tenants aren't going to be that disappointed to help you pay for it, because they're just going to pay a fraction of it. Each tenant will pay their fair share. But guess what? They're getting a really nice center. The parking lot's getting upgraded. The lighting poles are turning to LED. The roof leaks are getting fixed. All of this stuff is happening. And if you can get your renovation paid for by the tenants in like a partnership, because I think a lot of people are like, well, how do you raise all that money? It's eating into my returns to renovate. But really, if you have the right leases in place, you can do it with the tenants.
Yeah. You're underwriting deals. You're either buying or you're not. If you're buying, you're looking at deals, in my opinion. That's what buying looks like. You got to look at a lot of deals. I think you're at an immediate disadvantage if you only buy deals that you will drive to. It's just going to be inherently more challenging, and you're going to have to be patient, because I know Tulsa. If I only bought retail centers in Tulsa, I would wait and wait and wait.
You might get one a year, and you might have to overpay for it.
You would definitely have to overpay for it, and you'd be so excited you'd do anything just to get it in contract. You'd be like, please, this is I've been trying to find a deal all year.
Even if it was within driving distance. Oklahoma City, maybe into Arkansas, Texas, still you're going to wait, right?
I still think it's easier to buy out of market than in market. You trust the data. You've got all of the biases in town. Out of town, there's none.
Like you said, you don't fall in love with it necessarily. If it's here in Tulsa and we drive by it and we actually visit it a lot and there's some places that we like to go inside that center, then you kind of fall in love with it, right?
Yeah, I drive by and I want to put flowers in it, and then you guys are giving me crap. Braden, why are we wasting all these money on flowers? I'm like, it looks good, guys. I drive by it.
Sprinkler system.
Well, hey, hopefully this was helpful.
Yeah.
Once again, guys, you don't have to buy commercial real estate, but if you got really good at underwriting and finding deals, you could make a pretty good living just by handing those off to groups like us that do want to buy it. And pretty soon, with that experience, you'd be on your way to buying them yourself. So this is a great way to get involved, become an expert at finding and evaluating deals that could lead to you owning them.
Yeah, and even more than that, it helps when looking for just investments. You're going to have to filter through our investments and figure out which ones you like. Some you're going to like more than others, and you're going to learn that by looking at all of our investments, right? The same with others. You're going to see these Facebook ads, 7 pref and a 12% IRR. You should learn through repetition and tons of underwriting of looking at deals or other sponsors' offerings.
What to expect.
That seems low.
Yeah.
Like 12%. That's rookie numbers. We got to get those numbers.
Get those numbers up.
All right, we'll leave you with that. We'll
All right,
see you guys
guys.
next
Have
week.
a great week.
Okay, thanks.